With this video, we take on adjusting entries. This video will pick up on our coats and arms example from previous videos. You need not have watched those videos to follow this one, but of course, having done so will probably facilitate the learning process. Consider our previous journal entries. Obviously, they all had some impact on our accounting equation. Assets, liabilities, and/or equity were altered as a result of these transactions. The key word there is transaction, meaning we had some sort of interaction with a third party. As a result of that interaction, CNA had to record a journal entry reflecting the changes in the accounting equation. For instance, upon the purchase of those supplies in number 3, CNA acquired a supplies asset as well as a liability to the vendor. Note that not all changes in the accounting equation stem from interactions with outside parties. Sometimes they stem from internal activities, as we'll see with our adjustments. Before we proceed, I want to note that Thaddeus began operations on December 1st, and CNA has a fiscal year ending on December 31st. Sometimes our accounting equation may change without such an interaction. For this reason, we have our adjusting entries. Adjustments are made for changes in equity, namely from expenses, or equity outflows, and revenues, or equity inflows. Among our adjustments for expenses, we have prepaid and accrued expenses. For revenues, we have unearned and accrued revenues. Let's go over these individually. Let's examine prepaid expenses in more detail. The prepaid insurance contract from transaction 12 is an obvious example. When Coats and Arms acquired the contract, that entry debited an asset account as seen in the original entry. The contract was for 24 months. So if we divide the $2,400 cost by 24 months, we get a monthly expense of $100. Consequently, we'll decrease our asset for $100 and do the same to our equity. As for the journal entry, the consumption of the asset is an expense, which we debit, and to reduce our asset, prepaid insurance gets a credit. Recall that CNA acquired $10,000 of supplies to get the business running. As you observed on the previous slide, the accounting equation is always helpful to decipher transactions. Before watching my previous videos, you might have thought that transaction was an expense. However, supplies are just another form of a prepaid expense, similar to the prepaid insurance example we just covered. Yes, our cash asset did decrease with that purchase, and if we had immediately used all of those supplies, we would have an expense. However, we only purchased them, so we acquired a company resource, or increased our assets instead. Our expense is incurred from the use or consumption of those supplies. At the end of the month, we look in our supply closet and see that we have $6,000 of supplies remaining. We purchased $10,000 of supplies, and we have $6,000 of those supplies left. So how much did we use? $4,000. That's our expense. Our adjusting entry will be to record a debit to supplies expense, which decreases equity, and a credit to supplies, which decreases assets. Machinery and equipment constitute yet another form of a prepaid expense. Recall how CNA acquired $16,000 of equipment assets on credit. Obtaining the machinery was not an expense. Expenses only happen as we consume resources. That said, this machinery won't last forever. None do. Whenever CNA operates them, it's using up some portion of their finite lives. It's the consumption of the machine's lives that constitutes the expense. As for the machinery, it's prepaid because the cash disbursement happens before, or at least much sooner than the expenses incur. Now, I realize with this particular transaction, the asset was acquired with a liability, not cash. However, as an account payable, this amount will be paid off in a matter of months, depending on the credit terms. As a non-current asset, the equipment will be expensed over a number of years. Since the cash disbursement is completed before all the expenses are finished, these assets are still a prepayment. When we expense assets like machinery and equipment, we expense them via depreciation or depreciation expense. Prior to taking an accounting course, you probably thought of depreciation as declines in market value. For instance, if you buy a new car, as soon as you drive it off the lot, it loses 30% of its value. That's not the kind of depreciation we're talking about as accountants. In accounting, depreciation just means expensing the cost of an asset over its useful life. It's linked to our matching principle of recording an asset's expense in the periods benefited by its use. Assets that get depreciated include those like machinery, equipment, vehicles, computers, and buildings. We record their depreciation expense with a debit. Unlike other expenses, we won't credit the asset account itself, equipment in this case. Instead, we will credit accumulated depreciation. We do so because, unlike assets like supplies, our equipment doesn't disappear as we use it. We can observe when we've used up most of our supplies via their disappearance. Not so with an asset like an automobile or a piece of machinery. Like office supplies, it won't last forever. But we can't observe its consumption in the same manner. Accumulated depreciation is a contra asset account, which means we will place it on the balance sheet with its parent asset account, but accumulated depreciation will be increased by credits, not debits. Spoiler warning, we'll look in our eventual general ledger and see the balances in those respective accounts and put them on our balance sheet. Since accumulated depreciation carries a credit balance in contrast to the debit balances of all our other assets, accumulated depreciation will show up as a negative amount. We'll then take the difference between the two, which will be our net book value. Net book value is just the amount of the asset we have left to use, or the unexpensed portion. Again, we show it like this because we can't physically observe the consumption of things like machinery and equipment. We'll talk more about depreciation in more detail in a future video. For now, this is all you need to know. So how much will we depreciate? Our depreciation expense is going to be mostly an estimate. For now, all depreciation will be conducted using the straight line method. Our formula for the straight line method is as follows. We take the asset's cost and subtract from it the asset's salvage value. Salvage value is just a guess as to how much this asset will be worth at the end of its useful life. This difference is the depreciable amount. The total amount will ultimately expense. We then divide the depreciable amount by the asset's useful life. Again, this amount is another estimate of how long we expect the asset to last before needing replacement. The ending result is our annual depreciation. Let's examine the $16,000 piece of equipment from transaction 5. Imagine it has an estimated salvage value of $1,000, and we estimate it will last for 10 years. How much will we depreciate for the month of December? We subtract the $1,000 salvage value from the $16,000 cost to get the depreciable amount of $15,000. Divide that amount by 10 years, and our annual depreciation is $1,500. Remember that CNA has only been in operation for a month, so we need to convert that depreciation from an annual to a monthly basis. To do so, take the $1,500 depreciation amount per year and multiply it by 1/12. CNA will depreciate $125 per month. Our entry, debit depreciation expense, and credit accumulated depreciation for $125. What other assets will CNA depreciate? Recall that CNA acquired the following fixed assets in transactions 1, 2, and 4. The term fixed in fixed asset just means depreciable. Let's presume those assets have the following salvage values and useful lives. Pause the video and see if you can figure out their depreciation amounts for December, as well as their respective journal entries. We'll first figure out the annual depreciation for each group of assets in the same manner. First, subtract each asset's salvage value from its respective cost to get its depreciable amount. The equipment will have a depreciable cost of $21,000, the building $135,000, and the automobile $13,500. Next, we divide these amounts by their respective useful lives. The resulting quotient is each asset's annual depreciation. The equipment will have an annual depreciation of $2,100. The building will have an annual depreciation of $5,400, and the automobile will have an annual depreciation of $2,700. Multiply each of those amounts by 1/12. Their monthly depreciation amounts will be $175, $450, and $225. Now that we have the amounts, the journal entries are a cinch. Just debit depreciation expense and credit accumulated depreciation for each of these amounts. If you like, you could condense these three entries into one as seen here. Our next adjusting entry is accrued expenses. If the prepaid expense adjustment scared you, don't worry, this one is easy. All you need to remember is what an expense is. Whenever we consume one of our own assets or utilize a service from someone else, we record an expense. You can think of purchasing a service from someone else as a consumption of our cash asset. The expense decreases our equity, and our cash payment for that service decreases our assets. An accrued expense is what happens when we consume a service from someone else but don't pay immediately. In this case, we haven't consumed our cash asset yet, but we have an obligation to do so by paying that other party in the near future. The expense is still a decrease in equity, but that obligation to pay in the future is an increase in liabilities. As an example, recall in transactions 6 and 11 when CNA paid its employee $1,800. Focusing on that latter payment, let's rewrite some history. Imagine the employee is paid on Friday for 2 5-day work weeks from Monday through Friday. What if the year ended on a Tuesday before the Friday pay date? In that case, we'd have to accrue for how much CNA owes the employee as of that day. When this employee comes to work, he's providing CNA with a service, and he gets paid every 10 workdays in exchange for those services. If he's paid $1,800 for every 10 workdays, then he's giving CNA $180 worth of services every day. As of Tuesday the 31st, he's provided 7 days of work since the last paycheck, and CNA owes him for those 7 days, or $1,260. If it helps, think of the calendar. The employee is paid every 2 weeks on a Friday, but we're preparing our financial statements as of the 31st. As of this date, we only owe the employee for these days. For this reason, we'll book an accrued expense. We'll debit our salaries expense and credit salaries payable. Just like accounts payable, salaries payable represents an established obligation to pay cash in the near future. What happens on Friday when CNA pays the employee? CNA will certainly pay the liability owed, and it will disperse the cash to the employee, but it won't pay out $1,260. The employee worked 3 more days, so we need to record another expense of $540. The 3 additional days times 180 per day. Total cash paid will be $1,800, the biweekly pay. That takes care of our adjusting entries for our expenses. What about our revenues? The first revenue adjusting entry we should discuss is unearned revenue. Imagine that 1 month before year end, a client paid CNA $900 up front for services to be delivered over the next 3 months. Note that this transaction is superfluous to CNA's original list of transactions. What's happening in terms of our accounting equation? Our cash is increasing, so that's an increase on the asset side of the equation. Have we earned this money as of its receipt? Nope, so it can't be a revenue. Remember, we only record revenues when we've done the work to earn that money. This cash doesn't represent money earned. Rather, it represents an obligation to provide a service to our client over the next 3 months. In other words, it's a liability. We'll record this entry with a debit to cash and a credit to unearned revenue. At year end, CNA records its adjustment for the portion of that advance payment it earned. If that $900 covers 3 months of service, that means that CNA will earn $300 of that advance payment every month. What's our adjusting entry? Well, we've earned $300, and when we earn the money, we'll credit a revenue, fees earned in this case. What's our debit going to be? It's not cash. We've already debited cash when we received the advance payment. Instead, by providing our service to this client, we satisfied our obligation, so we'll decrease liabilities with a debit to unearned revenue. If you're especially perceptive, you might have noticed that unearned revenues is the opposite of prepaid expenses. When CNA received that advance payment, it debited cash for what it received and credited its liability, unearned revenue. The cash that CNA received is the cash that the client paid, which he credited out of his assets. However, the services owed to the client is an asset to him, so he will debit a prepaid account. When the adjustments are booked, CNA credited fees earned, increasing its equity, and debited unearned revenue for the portion of the liability satisfied. The revenue earned by CNA is an expense of the client, a debit. Here, the client consumed a portion of his prepaid asset by receiving these services from CNA, so he'll credit his prepaid asset account. This brings us to our last adjusting entry. Much like prepaid expenses and unearned revenues are opposites of one another, accrued revenues are the opposite of accrued expenses. Remember that revenues are increases in our assets and equity by providing a service or good to a customer. Whenever we do the work to earn the money, we record a revenue. Let's imagine that at year end, CNA completed a job for a client in the amount of $25,000. The completion of that job is what entitles CNA to be paid. In other words, it has officially earned the money, so that'll be a credit to revenue. However, the client hasn't paid cash just yet. The client hasn't even had the chance to, so the asset we debit is not cash. Rather, we debit accounts receivable. Note the word receivable in that account name. If a payable account indicates we have an obligation to pay money in the near future, a receivable account indicates that we have the right to receive money in the future. The right to receive or collect money is an asset. To summarize our adjusting entries, with prepaid expenses, we initially recorded a debit to the prepaid asset account and credited our cash for the purchase of that asset. At year end, we record our adjustment by debiting an expense and crediting the prepaid asset. Note that if the prepaid asset is a fixed asset, like machinery or equipment, the expense we'll debit will be depreciation expense, and we'll credit accumulated depreciation. With unearned revenue, we initially recorded a cash payment in advance of earning it, so we debited cash for what we received and credited unearned revenues to convey our obligation to provide a good or service in the future. At year end, we adjust for how much of that obligation we've satisfied, so we debit the unearned revenue to remove the liability and credit a revenue account since we've earned some portion of that advance payment. For accrued expenses, we've consumed a service from a third party, be it another company, a government organization, or our employees. So that's a debit to expense, and we credit a payable for the amount we'll pay in the future. For accrued revenues, we've earned the money from one of our customers, but the customer hasn't had time to pay us. So we'll credit a revenue account to convey that we've earned the money, and we'll debit a receivable account to reflect our right to collect cash in the near future. Also be aware that your textbook may categorize adjusting entries in a slightly different manner. Specifically, prepaid expenses and unearned revenues are referred to as prepayments. This is because the cash outlay happens before the revenue or the expense is recorded. Accrued expenses and revenues are simply classified as accruals. Accruals are the opposite of prepaids. The expense or revenue is recorded first, and the cash flow happens later. Beyond that, pay attention to some of the terms in these account names. Prepaid means that we pay someone else in advance, so that party owes us a service. You may see accounts like prepaid insurance or prepaid rent. Receivable means that the other party owes us money. Common receivable accounts include accounts receivable, interest receivable, rent receivable, and so forth. Prepaid and receivable will always signify an asset account. Unearned means that someone else has paid us in advance, so we have an obligation to deliver a service or good in the future. Similarly, payable means that we have an obligation to pay cash in the near future. These accounts are the opposite of the corresponding receivable accounts. Accounts payable, interest payable, notes payable, rent payable, etc. Consequently, the terms unearned and payable will always signify liabilities. That concludes this video. My next one will address the impact of omitting adjusting entries. I'll take a fairly complicated topic and hopefully simplify it for you, so please check that one out. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, please leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, please share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.